You're sitting at the dealership looking at the paperwork. $487 a month for 72 months. The salesman says it's nothing, less than $500. Your old car needs $2,800 in repairs, and this one is brand new, under warranty, no surprises. You're 71 years old, living on Social Security and your retirement savings. That feeling in your chest, wondering if you're about to lock yourself into something that's going to squeeze you for the next 6 years. That's what we need to talk about today. Most people think a car payment is just math. Monthly income minus monthly expenses equals what you can afford. But when you're living on a fixed income in retirement, a car payment isn't math. It's a chain around your ankle for years, and most retirees don't realize how dangerous that chain becomes when your income stops growing, but everything else keeps getting more expensive. My name is David Harrington. I spent over 2 decades as an investment banking analyst and portfolio strategist, navigating market cycles, recessions, and financial bubbles. After stepping away from institutional finance, I now focus on helping everyday people, especially those approaching or enjoying retirement, understand money in a calm, practical way. Before we continue, a quick note. This isn't financial advice. Everyone's situation is different. Think of this as education to help you ask better questions and make calmer decisions. By the end of this video, you'll understand exactly why car payments work differently when you're retired, and what that $487 a month really costs you over the life of that loan. If this kind of practical retirement guidance is valuable to you, go ahead and hit that subscribe button and the notification bell. And if you find this helpful, the like button really does help other retirees find this information. Now here's what most financial advisors won't tell you about car payments in retirement. It's not about whether you can technically afford the payment right now. It's about what happens to your breathing room over 6 years when your income is fixed, but your car payment never misses a month. Think about your monthly retirement income. Let's say you're bringing in $3,200 a month between Social Security and a small pension. That number isn't going up. Social Security gives you a cost of living adjustment most years, but we're talking about 2%, maybe 3% in a good year. Your pension? Probably frozen. Your savings? You're trying not to touch them more than you have to. Now at a $487 car payment for 72 months. That's 6 years. You're not 35 years old expecting raises and promotions. You're living on what you have, and what you have stays roughly the same while everything else quietly climbs. Your property taxes go up. Your homeowner's insurance increases. Your Medicare supplement premium gets a little more expensive every year. Your prescriptions cost more. The grocery bill keeps creeping higher. But that car payment, it never adjusts. It never cares that your heating bill doubled this winter, or that you need new glasses, or that your granddaughter is getting married and you want to help. It just sits there, due on the 15th of every month, for $187 for 72 months straight. Let me show you what this means in real life. That $487 payment is roughly 15% of a $3,200 monthly income. Doesn't sound terrible, right? But here's what happens. Year 1, you're fine. You planned for this. Year 2, your property taxes go up $60 a month. Your Medicare supplement increases $45 a month. You're still okay, but it's tighter. Year 3, you need dental work that insurance won't cover. $2,400. You have to pull it from savings because the car payment doesn't pause for your teeth. Year 4, inflation has quietly pushed your grocery bill up 12% over where it was when you bought the car. That's another $75 a month you didn't budget for. Your car insurance went up too. New car, higher coverage. Add another $40 a month. Year 5, the furnace dies. $5,200. Your emergency fund takes the hit, but now you're nervous because your cushion is thinner and you still have a year of car payments left. Year 6, you make it. The car is paid off, but your savings are $8,000 lower than they would have been. Your emergency fund is depleted, and you're 77 years old with less margin for error than you had at 71. That's the hidden cost of a car payment on a fixed income. It's not just the $487 times 72 months. It's what happens to your flexibility when life throws you things that don't care about your payment schedule. Here's what I learned watching retirees navigate this over 2 decades. The car payment itself isn't what breaks you. It's the rigidity. When you're working, a car payment is uncomfortable but manageable because your income has some elasticity. You get a raise. You get a bonus. you pick up over time. You have options. When you're retired, you have your monthly income and your savings. That's it. A car payment takes a fixed chunk of that fixed income and locks it away for years. Now you might be thinking, but David, my old car needs constant repairs. Isn't a new car actually cheaper? I hear this all the time, and it's a fair question. Let's look at the math honestly. Your old car needs $2,800 in repairs right now. Let's say over the next 6 years, you spend another $4,000 keeping it running. That's $6,800 total over 72 months. That's $94 a month averaged out. The new car? $487 a month times 72 months is $35,064. Plus insurance increases. New cars cost more to insure. Let's say that's an extra $40 a month over 6 years. That's another $2,880. Total cost, $37,944. You spent $31,144 more for the certainty of no repairs. Was that certainty worth $31,000 of your retirement savings? Maybe it was. I'm not here to judge. But most retirees don't do this calculation. They compare $2,800 in repairs today against $487 a month and think the monthly payment sounds easier. It sounds easier because it's deferred pain. But deferred pain on a fixed income is still pain. It just lasts longer and accumulates interest. Let me give you another angle on this. That $35,064 you're spending on car payments over 6 years, what else could that money do for you? If you kept your old car running and left that money invested conservatively, earning even 4% annually, you'd have roughly $40,000 after 6 years. That's nearly a year and a half of living expenses for most retirees. That's long-term care insurance premiums paid. That's helping your grandchildren with college. That's real security. But here's where it gets even more important. When you're retired, your car isn't a status symbol or a career tool. It's transportation. It gets you to the doctor, to the grocery store, to your grandkids' school place. A 2015 Honda Accord with 110,000 miles does that job exactly as well as a 2024 model with 300 miles. The difference is one of them cost you $487 a month for 6 years, and the other one cost you $1,200 in repairs every 18 months. I want to be clear about something. I'm not saying never buy a car in retirement. I'm saying never finance a car in retirement unless you have absolutely no other choice. If you need a different car, save up and pay cash. Buy a 3-year-old certified pre-owned vehicle for $18,000 instead of a new one for $35,000. Get a solid, reliable car that you own outright from day one. Why does this matter so much? Because ownership creates flexibility, and flexibility creates peace of mind. When you own your car outright, you control your insurance coverage. You can raise your deductible. You can drop comprehensive coverage if the car's value doesn't justify it. You can make those decisions based on your situation, not the lender's requirements. When you're making payments, the lender decides. You're carrying full coverage whether it makes sense for you or not. More importantly, when you own your car, you have options. If life gets tight, you can choose to skip the new tires for 6 months. You can delay the timing belt replacement if you have to. I'm not recommending this, but the option exists. With a payment, there are no options. The bill comes every month, whether you can afford it or not. Miss 2 payments, and they repossess the car you've already paid $10,000 into. Now you have no car and no money. Here's what surprised me most in my years helping retirees. The people who felt most financially secure weren't the ones with the newest cars or the fanciest houses. They were the ones with the fewest monthly obligations. They owned their cars outright. They paid off their mortgages. Their monthly nut was small, just utilities, food, insurance, and property taxes. When something unexpected happened, they had room to breathe. They could absorb the hit without panic. The retirees who felt stressed, they had car payments, mortgage payments, maybe a home equity line they were servicing. Their fixed income was already carved up before they even started thinking about living. Every month was tight. Every unexpected expense was a crisis. They had assets. They weren't poor, but they felt poor because they had no flexibility. This connects to something most financial advisors don't emphasize enough. In retirement, cash flow matters more than net worth. You can have $800,000 in retirement accounts and still feel broke if you have $2,200 a month in fixed obligations against $3,000 a month in income. You're technically fine, You've got assets, but you feel trapped because you can't access that $800,000 without penalty or taxes or selling at the wrong time. The retiree with $400,000 in savings, but only $1,200 a month in fixed obligations against that same $3,000 monthly income, they feel wealthy. They have breathing room. They have options. They can handle surprises. Same income, half the assets, but double the peace of mind because their monthly cash flow isn't strangled by payments. This is why car payments are so dangerous in retirement. They're not dangerous because you can't technically afford them. They're dangerous because they strangle your cash flow for years at exactly the time in your life when flexibility matters most. You're not going to get a raise. You're not going to get a promotion. You're living on what you have, and a car payment takes a piece of that every single month for 6, 7, sometimes 8 years. Let me give you something practical you can use. If you're looking at a car payment right now, do this calculation. Take your total monthly retirement income, Social Security, pension, whatever you're drawing from savings to live on. Now subtract all your fixed expenses: housing, insurance, utilities, prescriptions, food. What's left is your margin. That's your breathing room. That's what absorbs life when life happens. Now subtract the car payment you're considering. What's left? If the answer is less than $500 a month, you cannot afford that car payment. I don't care what the dealership's calculator says. I don't care that your credit score qualifies you. If that car payment drops your monthly margin below $500, you're setting yourself up for stress that will last years. Why $500? Because that's roughly what you need to handle normal life surprises without dipping into savings or panic. Unexpected prescription, vet bill, helping your daughter with her water heater, holiday gifts, slightly higher utility bill during a harsh winter. That's all $500 a month territory. If your margin is smaller than that, you're always one surprise away from crisis. And here's the thing most people don't realize until it's too late. A car payment doesn't just reduce your margin by the payment amount. It increases your other fixed costs too. Higher insurance premiums, higher property taxes in some states because you have a more valuable vehicle. You're not just losing $487 a month. You're losing $530 or $550 a month, and it all comes out of your breathing room. I saw this pattern repeat over and over in my years working with retirees. Someone would come in feeling stressed about money. We'd go through their budget. Everything looked fine on paper. Good income, reasonable expenses. But they felt broke. Why? Car payment, mortgage payment, fixed obligations eating 75% of their income, leaving them with $200 a month of margin after everything else. Technically solvent. Emotionally drowning. We'd work out a plan. Pay off the car early, even if it meant pulling from savings. Suddenly, they'd have that $487 back every month. Their margin would jump from $200 to $687. Same income, same lifestyle, but completely different emotional reality. They could breathe. They could handle surprises. They could enjoy retirement instead of white-knuckling through it. That's what I want you to understand. A car payment in retirement isn't about the car. It's about control over your life. Every monthly payment you eliminate gives you back a piece of control. Every dollar of margin you create gives you a little more peace of mind. So what do you do if you absolutely need a different car? First, exhaust every option to keep your current car running. Get a second opinion on those repairs. Shop around for a good independent mechanic instead of the dealership. A $2,800 repair that buys you 2 more years is $116 a month. That's better than $487 a month for 6 years. If your car is truly done, transmission gone, frame rust, something terminal, then start saving. I know that's not what you want to hear. You want a solution today, but give yourself 6 months. Put aside everything you can. Sell something. Cash in a small CD. Ask your kids if they want to go in together on a car for you as a combined birthday and Christmas gift. Do whatever it takes to come up with $8,000 to $12,000 in cash. With that much, you can buy a decent used car from a private seller. 2015 to 2018 model year. Honda, Toyota, maybe a Ford if you find the right one. Get it inspected by a mechanic you trust before you buy. Yes, it'll need maintenance. Yes, it might need repairs. But you'll own it outright, and that ownership is worth more than warranty coverage when you're living on a fixed income. If you cannot wait 6 months, if your car died yesterday and you need transportation now, Then buy the cheapest reliable car you can find and finance as little as possible. Put down everything you have. Finance $8,000 instead of $35,000. Get a 3-year loan instead of 6 or 7. Make it hurt. Make it uncomfortable. Pay it off as fast as you possibly can, even if that means pulling from savings. Get out from under that payment before it has time to strangle your cash flow. And if you're sitting here thinking, I already have a car payment, what do I do now? Pay it off. I know you might have heard that it's smart to keep low-interest debt and invest the difference. That advice is for 35-year-olds with growing incomes. You're retired. You're living on a fixed income. The peace of mind of owning your car outright is worth more than the theoretical 2% arbitrage between your loan rate and your investment return. Run the calculation. How much do you owe? Look at your savings. Can you pay it off today without dropping your emergency fund below 6 months of expenses? If yes, do it. Write the check. Own the car. Get that monthly payment out of your life. The psychological relief is worth more than the spreadsheet says. If paying it off completely would wipe out your emergency fund, then attack it aggressively. Double your payments. Triple them if you can. Every extra dollar you throw at that loan is a dollar you're giving back to your future self as monthly margin. It's buying you breathing room. It's buying you flexibility. It's buying you peace of mind. Your future self is sitting there 6 years from now, looking at their bank account, trying to figure out how to pay for something unexpected. If you keep making minimum payments, your future self has less money and less margin. If you pay this off fast, your future self has more of both. Which person do you want to be? This is the reality of car payments and retirement that nobody wants to talk about. They're not about the car. They're about control, flexibility, and peace of mind. They're about whether you're going to spend the next 6 years feeling squeezed every month, or whether you're going to own your vehicle, control your cash flow, and give yourself the margin to actually enjoy retirement. You have one retirement. You've spent 40 or 50 years working for this. Don't spend it making payments to a bank for a depreciating asset. Own your car. Control your expenses. Protect your margin. That's how you create the kind of retirement where you sleep well at night. Your future self is counting on you to make the decision that creates breathing room, not the decision that sounds easy today but squeezes you for years. Start taking action today.